welcome to the June 5th edition of Freightonomics 2025. Been a heck of a year for supply chains. I'm Zach Strickland, head of Freight Market Intelligence. Thomas Wasson is my co-host of the week, jumping in from Firecrown FreightWaves, truckload market expert over there, or trucking market. What do they call you over here?
Trucking analyst now. The more I move up, the shorter my title. One day I'm just going to be analyst or the guy.
We got clearly the supply chain is continuing to throw us into the headlines. We got Dr. Zach Rogers today as well. He's going to give us that latest LMI update, which was very spicy. Inventory costs really driving some of the headlines for this month's report on the LMI. So we'll get to him in a minute. But first off, Thomas Wasson, we've got this Memorial Day, road check week, May transition into the summer month activity in the domestic trucking market. Is there anything that you've heard or seen, any trends that you would say kind of stick out to you this month so far?
I love the return of seasonality. And so I think that's going to be the biggest thing that we're looking at, is that for having COVID and having that situation where for the past, 4 years, the data sets were just, imagine a big old goose egg from like 20 to 2022. And now we're back to this before 2019 seasonal predictability. It's a great sign. We saw the bump with road check. We saw Memorial Day. We're in that point where we're coming towards the 4th of July, which is one of the high points before we see peak season. So from a truckload market standpoint, I think if it was like Goldilocks, we went from too hot, it became too cold, and now we're on to number 3. We're kind of looking for that just right as conditions are very fertile, but at the same time, it's important to have a caveat. We're not going to suddenly see, COVID level stuff. So I think this is the year of recalibrating expectations.
I love it. So I've got some data to go along with your story there about how we've gotten into this lukewarm environment for the trucking market. Let's say we do a market in 2.
Let's do it.
All right, guys, whenever you're ready, let's just go right into it. Let's start with our first chart here at OTRI. This is the most interesting chart to me. I kind of flip back and forth between OTVI and OTRI as kind of my go-to charts to start things off. OTRI being the most interesting to me at this point because guess what? We're already higher than July 4th of last year. 6.67%. Not super high. From a historical standpoint, in COVID, we were up above 20% for a very long time. But the fact that we've year over year, you're seeing 2023, 2024, and then 2025 there in white, we're outperforming each year. The market has been tightening. We are losing capacity. Networks are consistently more strained than they were. Has this translated necessarily into a rate inflation? Not significantly. Let's go to the next chart and look at the NTIL. So we've got a little bit of this divergence where, yes, spot rates are higher year over year, but not a significant amount higher. A little bit of inflation going on here with the cost inputs. But the fact that we're not seeing the same kind of influence, the rejection rates still kind of higher. The spot rates are kind of coming down. This is a manifestation of something where carriers are just unwilling to commit to a market. We saw it in 2020. I want to pull up the next chart here, which is actually kind of a story of this. Rejection rates lead spot rates in these environments. And you can see the spot rate here in Atlanta is in green, and then you have the rejection rate for the spot rate from Atlanta to Chicago, huge lane, in green, a rejection rate for the Atlanta market in white. See how long the elevation happens in the white line here for OTRI Atlanta, the Southeast, way more disrupted here over the last couple of months than some of these eastern or these western lanes. But it takes a while for the market to kind of recognize it and then commit to building that rate. And the last chart here I want to throw out there is demand is down and rejection rates are up. Look at that, the inversion there. OTVI measures truckload demand, not as high as 2023.
Boom. And that's the big, multimodal shifts. Who's getting a cut of the pie? We remember 2 years ago, everyone's buying intermodal rail containers, wondering what's going to happen with that. And so I think this is the year when we're looking at OTVI and you're thinking, well, why are volumes lower on a basis point? Well, because these modes have taken advantage of it. The old joke for a publicly traded trucking company is you get out of trucking. Look at JB Hunt. Congratulations. You're like 50% intermodal. I mean, we're seeing that trend. So I think that is one of the biggest long-term plays has been this shift among modes, but at the same time
Mhm.
rejection rates are higher. We know there's fewer capacity, and coming up we've got some regulatory changes, and if you want to shake the box, there's one of two ways: either enough capacity dies or enough demand comes in. We're getting a regulatory induced potential capacity crunch, but we'll need to see in the coming months.
Oh, we need to do a webinar about the capacity situation. Let's put that on the calendar here in a few weeks. I'm glad you're almost reading my mind intuitively because I have a chart for what you were just inferring about the modal shift. We've talked about this a lot over the last year. If we pull up the rail versus truck, so intermodal volume there in white, and the OTVI, which you just saw, is now in yellow, measures truckload demand. You can see last year this divergence of demand, and this was that modal transition that's still ongoing. And it's a pull forward type world where a lot of these shippers push their freight back over to the rails, little moving storage, a little bit of lower costs, obviously cost management. And something we're going to talk about with Dr. Rogers here in a minute is the cost of warehousing and inventory has skyrocketed. So intermodal has a huge advantage over trucking in this type of environment where there is abundant inventory, which is something that I would be curious to hear his take in a minute on how much that's going to last. The next chart I want to pull up here, IOTI, we talk about it a lot, which is the Import Ocean TU Volume Index. This is based off of a 14-day moving average of departures from their ports of origin coming into the United States. Notice this big dip created by the tariffs on China being implemented there in April. And we saw this really die off. It was almost like a Lunar New Year dip. And now it's come back. Is it coming back all the way up to, crazy levels? No, but it is moving higher. This is a little bit slower index because it is 14 days, but we are seeing some signs that later in the month of June, maybe into July and August, we could have a pretty robust demand situation. And depending on where those inventories are, we could have some sort of modal conversion back to trucking.
And that's one of the big things to watch is, are we going to have an overflow or are we going to have a spillover effect? Because right now, the West Coast ports intermodal are like peanut butter and jelly. Like what, 50 to 70% of the volumes go from like Port of LA straight over to these railheads in Chicago, Dallas, and Atlanta. And so when we're thinking about that for trucking, you're almost like the catfish. You're waiting at the bottom of the pile. And if we start to see service disruptions, we start to see some indicators that there's strain on that, then it's going to be in a great position. So if all things go right, as a trucking guy, here's what I'm praying for. One, West Coast ports get more volumes. Two, intermodal bites off more than they can chew, and we'll see that with domestic containers, and we should see the fact that there's going to be more of the international containers going back. They're going to start transloading in a warehouse. If that happens, now it is my time to shine. And so I'm hoping I can get that action. But the only downside is, like you said, the inventory with Dr. Z. This is the big thing, because if I'm truckload, I'm worried if they're not in a hurry and they're paying a lot of money, they're not going to want to use truckload when I can save cost on the rail and I don't need it for like 2 weeks.
Well, let's bring on the man with the plan and get into this report, Dr. Rogers. If we can bring him on and get him started, and we can dive right into this warehousing situation. Dr. Z, how's your summer, man?
Good morning, gentlemen. Oh, summer's great. When I went to do my interview to be a PhD student, I remember the professor telling me, well, there's 3 reasons to be a professor: June, July, and August. And that's where we are right now, gentlemen. So I'm having a great time.
Oh, well, happy summer to you. So your report this month I found to be quite interesting, or spicy, as the kids call it. And the inventory cost component, along with declining inventory levels, I think is where we have to start. I can't bury the lead. John Kingston taught me that when I came to this media situation where it's like, always lead with the most interesting thing. And this to me was the most interesting. Do you agree?
Absolutely. Absolutely. So we saw a really interesting move this month where inventory levels are now almost not even expanding. And that's kind of that air pocket you showed a minute ago, that sort of second Lunar New Year of the
Right.
year. That really drove down inventory expansion. So inventory levels expanded at 51.5 in May. And just to remind everybody, 50 is kind of break even. So any number over 50 means expansion. further above 50, faster expansion, further below 50, faster contraction. So 51.5 is almost no movement. And when you break that down into where the buildup is happening, you actually see we had contraction at the retail level. So we break our responses into upstream and downstream. Downstream, which is consumer facing firms, so a bulk of that would be retailers, they gave us a 43.1 this month,
Ooh.
which is active contraction. And this goes back to what you're saying a minute ago. There's some places with inventory and maybe some places without inventory. And retailers are really bringing it down quickly. At the same time, upstream was a 56.5. So we are building up. And a lot of those would be sort of like LSPs, 3PLs, wholesalers. Kind of the middle mile is where everything is being stored right now. And it's putting a disproportionate cost on that middle mile. Let's talk about the cost though. So remember, we said inventory levels were 51.5. Inventory costs were 78.4, which is a huge jump from where we were. I mean, in like December we were at 61, and now we're way up. We're way up here. There you go at 78, and that's a 26.8 point difference between inventory costs and inventory levels. Now, inventory costs always grow a little bit faster. A little bit faster. You can see the two lines tracking together here for the last 5 years, always grow a little bit faster than inventory levels, but it's not normally this much of a divergence. The 26.8 that we read this month is the third biggest in the whole history of the index, only behind, I believe, September and November of 2021, when things were really, really hot. In fact, it's only ever been above 20 for a few periods. One is, you can see the yellow line going up real high in sort of late 21, early 22. And then we had one moment in August of 23 where it just got barely above the 20-point threshold for the delta. But that's because, as you can see, we were really trying to slash inventories at the time, so we had big inventory contraction. This movement that we've seen in terms of the space between these two metrics, which again should track together, it's the sharpest sort of growth we've seen for this delta in the whole 9 years we've been doing this. And what that suggests to us is that we pulled so much inventory forward in the first few months of the year, and it's just sort of sitting there. January, February, and early March looked a lot like September or August, September, early October. Normally those 3 months, happen right before the holiday season. Well, we didn't have a holiday season in mid-March this year, as we often don't. And so because of that, everything is just sitting there. And then what that leads to, and I think this is a little spicy too, warehousing capacity hits 50.0 this month. And so warehousing is basically at break even. That's the lowest we've been there since, we had one sort of dip down in March of last year. And if you remember March of last year, we pulled a lot of inventory forward thinking that interest rates were going to go down, and then they didn't go down for another 6 months. But before that, we're looking at 2.5 years since we saw warehousing capacity contracting like this. Warehousing prices are staying up in the 70s. Essentially what we have, guys, is all this inventory got pulled forward, and now it's sitting static inside supply chains. And where we're really seeing the biggest sort of reflection of that is when we split up our big respondents. So respondents, we basically draw a line at 1,000 employees and say anybody over that's on the big side, anybody under that's on the small side. And we've never seen divergence like what we're having with our big and our little firms. The larger firms, inventory's contracting. A lot of those would be the retailers, and costs are up, but not nearly as much as they are for our smaller firms. Smaller firms, we're talking inventory costs at 86, which is a crazy number. Available warehousing capacity at 44. Warehousing prices at 76. Transportation prices at 70. All of these are gigantic numbers. And essentially, guys, what's happening is, if you think about who's going to be bearing the cost of the tariffs, because of course there's costs associated with all these tariffs and everything that's going on, and even just the pull forward, there's a cost. It's not the retailers so much. it's also not going to be the big like super brands. Like if you think about like, okay, I'm going to go to Target and I'm going to buy a pair of Adidas shoes or something, or Nikes. Adidas isn't going to hold on to this extra stuff. Neither's Target. The little guys in the middle, the middlemen, those are the ones that are holding it. And that's what's showing up with our smaller firms seeing these out of control costs. Right now, the brunt of all of the extra costs of tariffs are being borne by the sort of middleman in the supply chains, which means a lot of the costs haven't really gotten to consumers yet. And not all of them will, some will stay there, but it's sort of putting a ton of pressure on the middle of the supply chain in a way that we really haven't seen in quite a while.
I kind of wonder about that. So it's marinating. We've got all this upstream kind of marinating large firms. And
Mhm.
so, as a trucking guy, I wonder if it's eventually going to see a position where we do see an uptick when we have to push it downstream. So these, when we're looking at distribution, DC to DC transfers, that may explain to me why we see OTR, our outbound tender rejection rates continuing to get elevated past 5, that 6 to 7%. Because I do wonder, like when I worked at a large company, we did a lot of the Fortune 100s, retail, consumer goods. And so that's one of the big questions I'm trying to find an answer to. And I wanted to get your thoughts on that. Do you think that it's kind of like a bottleneck and then it just, once it gets down, it pushes it all out at once, causing a thing? Or are we just going to marinate on it and write it down and expense it out and have like a sad Q2 earnings?
I think a little bit of both. I think that things will get pushed down. I don't know that it will be all at once though. It's all sort of staged early. And so instead of the kind of rush that we normally have when we're in a peak season, I don't know that we'll have that. I think we'll see things moving down slowly. Basically, what's happening is retailers are trying to have their cake and eat it too. And what I mean by that is we've pulled all this inventory over, spent all this money, kind of pushed a lot of our vendors to pull everything over. But as retailers, we would really like to stay JIT. And so I think retailers are going to stay as lean as possible. Now, that could be good for OTR because that means probably more movement, smaller movement, but more consistent movement, I would imagine, and less of a big rush of everything going downstream like we might see like in your average September.
Do you think, I mean, you mentioned the inventory level component is a 51, which is actually,
It's
lower than
seasonally
it's
normal.
been. Yeah. It's actually lower than
Yeah,
it's been.
that's
Do we
the
have,
thing. That's not a weird.
yeah,
That's not a weird number necessarily. Like when you just look at the surface, 51 in May, okay, that's not that far off
right.
of what we normally have, but it's the context that this is in.
Okay.
The context is in where we have, if we were at 51 with inventory levels and like 60 with inventory costs, we'd say, okay, normal sort of seasonal movements. It's the fact that inventory costs are almost at 80 and they're at
Right.
86 for small firms. And warehousing capacity is down to nothing right now. I mean, remember, guys, like 6 months ago, how we were talking about like, man, we got so much warehousing capacity. When are we ever going to fill it? Well, now we did it. We filled it. And so we've got all of this stuff sitting there. And so you're right. That's not an abnormal number for May, actually. But it's what came before it and the cost associated with it that tells us that that inventory isn't moving with the same velocity that we would normally want it to be. This should be kind of the time where supply chains are a little bit lean. We're not lean right now.
Do you think that there's a risk there to the middle ground? Do you think that they actually start to fail to an extent? There's some sort of, lump there that
Yeah.
that has some sort of weird. I wouldn't even know how to describe what would happen at that point. Do you?
It's like a snake swallowing a mouse, and it's like
Yeah.
just the lump is in the middle. Yeah, I think there could be some attrition at some level to the middle mile. It just depends on how fast things move. I think some folks are really hoping that there's going to be this big surge. We had the air
Yeah.
pocket, and I think the idea is, what goes up, must come down, right? And maybe because we had this air pocket, now we'll have a big rush, and it'll be just like 2021 when everything got crazy during COVID. And I do think that there will be an increase. I mean, we're already seeing second half of June at the ports looks pretty good in terms of what we're projecting. but I don't think that it will be like what 2021 is, and there's a few reasons for that. One is like we said, we already have high inventories. Two, we still have like 40% tariffs on China. I know that it's not 145% anymore, and it seems relatively low, but 40% is still pretty high. And we have the 10% tariffs all over everywhere else, 50% tariffs on steel and aluminum. So there is a lot of extra costs, even though it doesn't seem as bad. I mean, it's kind of like, when I used to live in Arizona, there'd be days in July where you'd think, hey, it's only 105 today. This isn't so bad. It was bad. My brain was broken because of what it's like to live in Arizona. And that's kind of the same as it is the tariffs. Yes, they're lower, but they're still much higher than we normally have. The other piece of that is, I wonder how much the psychology of the tariffs has changed in the last few months. And what I mean by that is, we saw these big pull forwards because people thought, okay, there's going to be punitive tariffs. We got to stay ahead of it. It was very logical. Now the tariffs kind of come on and come off, and they're totally not, predictable at all. And there's some boy who cried wolf sort of, vibes to it, I think. And so I think that some retailers are like, yeah, we could pull everything forward now when it's at 40%, just in case it goes to 150. But I bet it's not going to actually go to 150. I think this is a negotiating tactic. I mean, there was headlines today that there was apparently a nice call about rare earth metals. Who knows? Maybe in a month, tariffs between US and China will be 20%, and I'll just wait until then. And so I don't think, because of those things, I don't think we're going to see the big pull forward that results in this sort of panacea of volume that is able to sort of bring OTR back to where we were a couple of years ago. So I think there will be a spike up a little bit, but it won't be, and you kind of said this earlier, Zach, it won't be the kind of spikes like we were seeing in 21.
I want to do a follow up on that. I think the most clever thing is it's called anchoring. You buy a $50,000 car, they offer you a $3,000 plan. Well, you're already sold on the 50,000, so that's 145% tariffs.
Yep.
Now we're down to 40. The greatest magic trick is making us now not be mad about a 40% tariff from China. But looking at your data, you had a great commentary in the release about the state of the consumer as well. So we talked about boy cried wolf, giant container apocalypse. The consumer is no longer, I don't have $1 trillion of stimmy money, and so talking about that and then also pairing that with a wait and see, what were some of the more forward-leading statements? I like with the report and the index you have that you also asked them, what do we think things will be in the near term and long term? Give us some of the crystal ball in terms of what respondents are thinking about looking ahead on the movement of these prices. Will we see this kind of get better? Do we need Roto-Rooter to fix our warehouses?
I am very interested in the answer to this.
Well, hey, by the way, the anchoring effect is real. I teach it when I teach negotiation in my classes. You know how you deal with the anchoring effect? You don't say anything. You let the other person negotiate against themselves. Yeah. So there's the idea. I'll speak first. I'll set the anchor. The person who speaks second, you just look at them. Mm-hmm. It's like if you've ever texted somebody like, hey, do you want to go to dinner? How about pizza? They don't say anything. How about Mexican? They don't say anything. How about Italian? They say yes. You just negotiated against yourself. That's what we're doing right now. Just if anybody's wondering. Let's go to the crystal ball though. So that was Management 301 with Dr. Rogers. All right, let's go to the crystal ball though. So one of the things we see is quite a difference between our predictions for the future movements from our upstream folks and our downstream, again, retailer respondents. Retailers are expecting inventories to run at about 65 over the next year. Now that's a big departure from where we were. In 2024, I think downstream inventory levels averaged like a 52.7. And so to move up to 65.3, that's a pretty big change. And it shows that they will be building up inventories, likely due to the tariff issues. Because of that, future inventory costs downstream are 86, 75 upstream. So no slouch there either, but really high for our downstream folks. Warehousing prices at 86. And transportation prices at 80.6. Now, Here's an important number, fellas. When you add all of our three price metrics together, so it's a scale of 0 to 300, there's a pretty clear relationship between when you add all those up together. If they're above 240, and then a couple months later, you see increases in supply-based inflation. Like we saw really high costs in the supply chain through the second half of 21 into the first few months of 22. And that's really what, if you lag it, what sort of kicked off the big inflation that we had through the middle of 2022. Well, so 240 is kind of the magic number where it gets pretty intense. If you add up those numbers for our future costs, and this is only for downstream, not altogether, it's about 251. And so those are really high costs. And what that suggests to me is that you're going to have to push it somewhere, and it could be onto the consumer. And like you said a minute ago, this time we're pushing it onto a consumer, not like in 21 where, well, we just had $2 trillion rounds of stimulus. We haven't had serious inflation in 40 years. Now we have had serious inflation pretty recently, and there's no more stimulus money, it seems like, on the horizon. And so whether or not the consumers are able to absorb these big costs that are being predicted downstream is going to be basically the whole ball game in terms of what happens with the logistics industry over the next 12 months.
So, I mean, basically the read here is that while we do have some supply chain shock activity going on, we're not going to see some sort of knee-jerk reaction from the shipping community because they're kind of prepped. And also the demand component is in huge question, especially downstream. So that the pricing component of this is fascinating to me. I want to go back to transportation a little bit here. We've talked a lot about warehousing. The transportation component has been kind of like, we rarely stay on warehousing this long when we have these conversations, but transportation prices and capacity, the alligator mouth was closing there for a couple of months. It appears to be in a holding mode, not completely wide open at this point with the relationship between these two. But, you know, you mentioned the downstream and upstream difference here when we've talked about how the upstream has been feeling things very differently than the downstream. Do you see any more of that kind of manifesting this time, or is this are they starting to feel things similarly?
Well, you know, what's funny is that the costs are higher downstream, but capacity is much tighter upstream. So upstream, the difference is actually pretty good.
Okay.
It's 50.6 right now or actually, sorry, 50.0 for transportation capacity upstream, which is like, you know, no movement. We would like capacity to go below 50. We still haven't seen capacity go below 50 since like March of 2022 when the last freight recession started. We've just been absorbing. And their prices are at 61. So 50 and 61 is actually a great relationship. Downstream, it's 65 and 66. So downstream is actually slightly inverted from where we would want it, but costs are still high. And the costs are high just mainly because of the markets that downstream tends to operate in, the lanes they use versus upstream. And it's going to be really interesting basically to see, and this gets back to one of the questions earlier, if capacity comes down at the downstream level, when we eventually see this inventory matriculate down, I would expect some of the inventory is going to matriculate down probably by the end of July because you know kids are going to go back to school in August. And so really over the summer, seeing if those deltas between what we see with the alligator mouth, I like that, upstream versus downstream, if they get closer to each other, that would sort of indicate that we're moving back into a sort of equilibrium, which I think everybody would welcome.
Yeah.
Wait, for those who survive for capacity downstream, it's like green shoots, but which ones are going to turn into stalks, basically?
Yeah, I mean,
what doesn't kill you makes you stronger, guys. This is all survival of the fittest.
we sort of see, you know, that it's interesting because when you say upstream and downstream from a trucking market or service transportation market perspective, it tends to mean like West Coast, Southern California freight, or, you know, your Detroit freight or, you know, your import freight coming across the borders versus your megalopolis freight in the, you know, the big cities of the East Coast. And we've seen this crazy, I think it's interesting you say the costs are higher on the downstream side because that's where the rejection rate elevation has been. We have seen huge rejection rates off the East Coast, which are downstream focused, versus the West Coast, which has had the, you know, 2% rejection rate, which is basically, you know, what we would consider freight recession. So that's fascinating. Well, we only have 40 seconds left. Any final thoughts here before we close out the show, Dr. Z?
You know, I would say one of the last things, and you just kind of brought it up, is supply chains do look different than they did 5 years ago, right? 5 years ago, everyone would have just thought, just like you said, upstream is West Coast, downstream is East Coast. The balance is so much different now with where stuff comes in, things coming over from Texas to the road, different ports. One of the reasons we're not going to see the big bubble is because supply chains are better than they were 5 years ago. They're more balanced. So let's leave on a positive note. Good
There you
job,
go.
everybody.
All right. Thanks again. Have a great week.